Hello and welcome. In the world of investing, we spend most of our time talking about what to buy. Entire industries are built on giving you the next great stock pick, but the truth is, buying is the easy part. The truly difficult decision, the one that separates amateurs from pros, is knowing when to sell. Sell too early, and you leave life-changing gains on the table. Sell too late, and you watch those paper profits evaporate into thin air. Hold on forever, and you might just be clinging to a sinking ship. This dilemma is the source of more investor regret than almost anything else. But what if you didn't have to rely on gut feeling or fear? What if you had a clear, rational checklist, a set of rules to guide you through the emotional fog? In this video, I'm giving you exactly that, 5 clear rules for when to sell. This is your framework for making disciplined, unemotional decisions. Let's solve the dilemma. Before we get to the rules, we have to understand the enemy, our own psychology. Two powerful biases distort our sell decisions. First, there's loss aversion. We feel the pain of a loss about twice as intensely as the pleasure of an equivalent gain. This makes us hold on to losers for way too long, hoping they'll just come back, which can turn a small loss into a catastrophic one. Second is the disposition effect. This is a perverse tendency to sell our winners too early to lock in gains and hold our losers too long. This is the exact opposite of the wise maxim, cut your losses short and let your winners run. To combat this, you have to adopt two guiding principles. First, have a thesis for every single holding. You should be able to state, in one sentence, why you own something. I own this because ... This sentence is your anchor. Second, your decision is about the future, not the past. The money you've already lost or gained is irrelevant. The only question that matters is, what is the best decision for my portfolio from this moment forward? With that mindset, let's build your sell checklist. Rule number 1, the thesis is broken. This is the most important rule of all. You bought the investment for a reason. Has that reason fundamentally changed? For a stock, did the company's competitive advantage its moat erode? Did management make a disastrous strategic shift? Are the financial fundamentals deteriorating in a way that isn't just temporary? For a fund, has the fund manager changed? Has the fund strategy drifted from what you originally bought into? Or for a broader strategy, has new evidence emerged that invalidates your core assumption? For example, maybe you bought a value ETF, but the factor's long-term effectiveness is now in serious doubt. The action here is simple. If your original thesis for owning the investment is no longer valid, you sell. It doesn't matter if you're at a loss or a gain, you are not married to your stocks. This is a business partnership, and your partner is no longer holding up their end of the deal. Rule number 2, the valuation has become irrational. Even a wonderful company can be a terrible investment if you pay too much for it. When the price detaches from any reasonable measure of intrinsic value, it's time to reconsider. Look at the metrics. Is the PAE ratio at historic extremes compared to its own history and the market? Is the price-to-sales ratio astronomical for its sector? You can also use the crowded trade test. Is everyone talking about it? Has it become a cultural phenomenon disconnected from business fundamentals? This is all about narrative-driven euphoria. Now, an important caveat: for a broad market index fund, this rule is less useful. You're betting on capitalism itself. This rule is primarily for individual stocks or concentrated bets. When the valuation reaches levels you cannot justify with any reasonable future growth scenario, it's time to trim your position or exit completely. You don't have to sell all at once. You can scale out over time. Rule number 3, you need to rebalance your portfolio. This is the easiest and most mechanical sell rule. It removes all emotion from the process. Your investment policy statement or your asset allocation plan specifies your target percentages, for example, 70% stocks and 30% bonds. Over time, a winning investment will grow to become a larger portion of your portfolio than you intended, which increases your risk. For example, let's say your target is 10% in international stocks. A great year pushes that holding up to 14% of your total portfolio. Your action is to sell that excess for percent and use the proceeds to buy the underweighted assets in your plan. This systematically forces you to sell high and buy low. Rebalancing is not a market timing guess. It's portfolio hygiene. Rule number 4, you have a materially better opportunity. This rule requires rigorous honesty. It's not about chasing the next shiny object. It's about a genuine, researched comparison of risk-adjusted return potential. Here's the test. Can you articulate why the new opportunity is superior? Do you understand it just as well as your current holding? Does it offer a higher expected return for similar risk or a similar return for lower risk? The trap here is that this rule is most dangerous in the hands of an undisciplined investor. It can become an excuse for constant trading and churning your account. So, before you sell, write down your rationale for making the switch. If the new opportunity truly makes your current holding obsolete in the context of your overall portfolio goals, then and only then should you consider a switch. And finally, rule number 5. You need the money for a defined life goal. This rule is all about the purpose of your money. Investments are not abstract numbers on a screen, they are tools to fund your life. This could be the down payment on a house you've been investing for over the last 5 years. It could be for retirement income, where your 4% withdrawal plan calls for selling a specific asset. Or it could be rebalancing into safety as you get older and approach a goal, shifting from growth assets to preservation assets. The action is simple. You sell according to your predetermined financial plan. This is a victorious sell. It means your investment strategy is doing its job, converting capital into life choices. Now, there is one rule that is never a good reason to sell, and that is simply because the price is down. A price drop, by itself, is not a thesis, it is an opportunity. Unless the drop is accompanied by a breaking of rule number 1, the broken thesis of falling price should make you ask, is this now a better value? Not should I flee in panic? So, to quickly recap your 5 sell rules, the thesis is broken. The valuation has become irrational. You need to rebalance your portfolio. You have a materially better opportunity, and you need the money for a defined life goal. Print these rules out. Keep them next to your monitor. The next time you feel the itch to sell, whether it's out of fear during a market crash or greed during a bubble run through this checklist. Selling is not a failure. It is a strategic decision. By using a disciplined framework, you transform the most emotional moment in investing into a rational, repeatable process. You stop being a prisoner of market fluctuations and start being the architect of your own financial outcomes. Know why you buy, but know, even more clearly, why you would sell. Thanks so much for watching. If you found this framework helpful, be sure to subscribe for more content to make you a smarter investor. See you in the next video.